This is a special podcast presentation from 700WLW.com. This is Casey Boland on demand.
Casey Boland of Hanghold Capital Management is with me, and we talk stocks, investing, and all that stuff. And rocky end of the week last week due to Brexit, as we know. So what's a good buy right now, Casey?
Look no further than Europe. But a lot of people look at Europe right now and say, wow, why do I want to touch that? It's a complete mess right there. And, I'd have to say it's hard not to argue with that. We had a correction. A correction is defined as a drop of 10%. It's rare to get a correction all in one day, and that's, in fact, what we had in Europe last week. But, if you're patient, longer term, you may be rewarded for investing in Europe.
If you're looking at something from more of a long-term basis, as you do, you go back here and look at the S&P from the 70s and compare the U.S. versus Europe, and what do you find?
The results are very similar. The S&P averaged 10.3%. Europe has averaged 10%. So you've had very similar performance during that period. But you have these periods where things are cyclical. In recent years, U.S. has by far outperformed Europe. And, Europe does have its issues. You look at so many different aspects from the demographics, political uncertainty, little economic growth, negative interest rates. There's more things that could be added to that list on a negative front. So a lot of people say, why should I invest there now? The issue, though, longer term, you often find, first of all, we've had a little bit of a panic. Rarely does it pay to panic on crisis events. There's often a sharp reaction on the negative side, followed by a substantial rally. But when you look at stocks right now, some of the biggest moves in stock markets often come from when things go from looking really bad to good and from good to great. Once things are great, that's when the majority of the movements have already been made. That's when it feels the best to invest, but a lot of the moves have typically happened by then.